So I think a lot has been said in the financial services markets about consumerism. What's happening with the growth in consumerism is that people are leveraging themselves to buy new products, new goods. They're buying beyond their means, and I think that's fundamentally how the Western economies have flourished. It's good to have income, and based on that income, take debt, and based on that debt, have products which otherwise you would have had 5 years down the line or 10 years down the line. I think that's pretty much become the norm. So 10 years back or 15 years back, there were very few banks offering mortgage loans, home loans, personal loans, right, to be able to fund your immediate requirements. Buying a house is not so difficult as it used to be in the past because of these instruments which are available. Same with credit cards, same with the opportunity to make small ticket purchases which you could over a period of time, as against making a big ticket purchase today and deferring your payments over a period of time. The interesting thing about the credit card, which most people are now flashing from their wallets saying, here I have 3 and I have 2, is to understand how much credit is right for you. Taking credit beyond your income earning capacity is where the loop starts, that you can't necessarily pay back all the amount at one go. And so what do? You take credit and you start paying the minimum balance that is due, as against paying chunks of money as and when you have it. And that's where the credit loop starts. You'll end up paying interest, surcharges on late payment of those dues, and those are exorbitant. The bank earns money only when you revolve on your credit card, and the process of revolving is basically what the credit card industry revels on. There are very few people who only transact. The difference between transactors and revolvers is as follows. So I went and made a purchase. I spent 30,000 rupees on my credit card. My payment due date is 15th of January, and I'll end up paying only 5% of the dues. I roll over the balance dues, and that is revolving credit. The credit card company then charges me on the balance 95%, almost up to 33% interest, and they say 3% a month approximately, but that's the charge that you're paying for moving that money over. Some people can afford that because it's a short-term need. When they get their bonus or they get flush with funds, they pay off those cards. So it solves that short-term need. The problem occurs when it's never a short-term but becomes a long-term credit cycle, and you keep revolving, leading to the credit card company making a lot of money and you not ever being able to pay your credit card. That's the credit loop. A transactor in reverse is somebody who has the same 30,000 purchase and the credit card due date is 15th of January, lands up paying the full 30,000 rupees by the 15th of January. They've utilized the credit period. That is, instead of paying from their bank account on the day of purchase, they've managed to use the credit period that the credit card company offers, which is up to the bill date, to make the premium in full. The bank actually doesn't make too much money on this sort of a customer. The customer enjoys the credit period, but still has the facility that in the event that there is a short-term need, can revolve a little bit and then come back to being a transactor. It's important to learn how to use your credit card right. If you don't know how to seal your purse string, then it's better not to have credit card and use only a debit card. But if you can balance your income and expense, and for short-term needs and for utilizing the credit period that the bank offers, the credit card is a good instrument to have. How many credit cards should you have? That's a tough question. Usually, most people in their wallets should have 1 or 2, just to diversify the fact that they are working with 2 banks and maybe 2 cards. But the credit limits on each of those lines should not cross anywhere between 10 to 11 times of your monthly income. Anything more than that is extending your credit too much, and that's exposing yourself to too much of risk. Most banks don't offer more than 11 times of your monthly net take home as credit line anyway. But be sure that they'd be happy if you revolve up to 11 times of your annual income, because they'll make lots of money.